All right. Welcome to, this will be the first in a series that we're going to call the Stacking Returns series. And this is going to be, we're going to try and keep it as short as possible, but each of these different aspects of the return that you'll see with your investment properties is going to have to cover a couple different things. And we're talking about cash flow, tax flow, debt flow, time flow. It's kind of the way we think of these things. And when we talk to an owner about their property, we're considering all of these different aspects when we're looking at what's the best move for them to make. And what we find is a lot of people focus pretty exclusively on what is my cash flow for this investment, what is my cash flow for the next investment. And that's the only metric that they use to determine how good is the investment that I'm looking at. And there's actually probably a half dozen other layers to your property that you should probably be paying attention to, because this is what, if you're talking about the big, large investors, the people with 10,000 plus doors, this is what they're focused on. They're not focused on what is the cash flow today for this property. Okay, I got my debt. What's the cash flow? What's the return? What's my net income? What's my cap rate? They're not focused on it. There's actually quite a bit more to it. And I'd like to share with you just one piece of that. So this will be the first part of that Stacking Returns series. This is going to be on depreciation, cost segregation, how you can use that in conjunction with debt to achieve some pretty silly returns. And I am not a CPA. I am not a financial advisor, nor am I an attorney. I'm a commercial broker. So if you like what you're seeing here, I would recommend that you contact your expert and pick their brain about it. Don't take my word for it. This is purely for discussion purposes, even though the example I'm going to give here it's a real example and not an uncommon example, but it really illustrates the amount of money you can probably make by utilizing the right levers with regard to your property. And this is one of the reasons that we find, maybe holding on to a property forever might not be the best move, depending on your goals, right? So with that said, let's talk about depreciation and cost segregation with regard to your investment properties and how you can use it to really leverage up what your returns are and to strategize on what you should be doing next. So these are the four basic food groups that we're going to cover today. We're going to talk about what depreciation is specifically, and then we're going to go into cost segregation, which is ways to cut up depreciation, put them in different buckets. And then we're going to talk about how to take those buckets and accelerate it. So basically you get all of the tax savings as soon as possible. And then we're going to use our example and show you how that can work in real life. Okay. So what is depreciation? Let's go ahead and move this for now. I think we stacked our slides as full as possible. So depreciation, I like to call it adult pretending, really. And then at the end of the day, what we're really doing is we're saying, look, I've got a property. Over time, it's going to get worn down. I'm gonna have to replace stuff. It's gonna cost me money. I invested in it, but it's losing value. It's losing its integrity over time. Realistically, it's probably not. Realistically, it's probably gonna go up in value over time. All signs to point to that. But for tax purposes, we can say, look, it's going to be losing value over time. I'd like to claim that as a write-off. I like to claim that as a loss every year, right? Until it's theoretically on paper worth nothing. And the way that they've factored that and calculated that, and they said multifamily will turn into dust, basically. We're going to pretend that it's worthless after 27.5 years. And commercial, that's going to be 39 years. It's going to take 39 years for it to fall apart and turn into nothing and be worthless. So you get to write off as a taxable loss the improved value of your property over 39 years or over 27 and a half years. Isn't that cool? And your CPA is probably already doing that. Your financial advisor is already doing that. And you've probably also explored cost segregation as well. We're going to look at that. We're going to look at bonus depreciation and a couple things that you may or may not be aware of and where they're at today in today's market. But to start with, depreciation is really just saying, the improved value of the property is going to deteriorate over time. I want to get a taxable loss on my paperwork over that period of time. Now, depreciation falls into a couple different categories. Number one, we're talking about the improved property only. We're not talking about the land. Okay, so, and then you've got some different little minutia to talk about too. You've got the improved property, which is all of the improvements that I made. This includes the parking lot. This includes the curb and gutter. This includes all of the underground improvements too. So your plumbing and your electric, anything like that. That's going to be included as well. The unimproved part, the land, the trees, the rivers, the rocks, all your materials, that's unimproved. So that doesn't get to be depreciated. But then the question is, well, what if I have a farm? What if I have minerals or gas or oil or lumber, trees that I'm going to turn into lumber? Can I write those off? Well, no, that's part of the land. But once it's harvested, then it becomes goods, and goods can have their own depreciation schedule. That's a different discussion for probably more of a business owner than an investor. But we refer to that as depletion, right? When we're depleting the property of its natural resources, we're harvesting them, right? You can do the same thing with a farm that has a bunch of corn. You're harvesting the corn, you're depleting, right? You're pulling the goods off of the land. Depreciation only has to do with the improved value of the property and how that wears out over time. Now, that's depreciation. What is cost segregation? We're going to take all of that, and what we could do is we could say the improved value of the property is, for example, $1 million. I'm going to write that off over 39 years or over 27 and a half years. And all you do is you divide the $1 million by 39, right? So you get to write off 1/39th of your improved property every year as a loss. Great. But that's called straight line depreciation. But the problem then is a lot of things depreciate or fall apart a lot quicker than 39 years. Not everything can depreciate over the same schedule. That's where the cost segregation comes in. That's where our buckets come in. Okay, so we've got different buckets that we can put all of our different improved property into. That's going to be on different schedules. It's going to be on a longer or a shorter schedule. Okay, and that's all cost segregation is. We're taking that 39 or 27 and a half years and we're breaking it up into its constituent parts. And here's what that looks like. Okay, you got your 5-year bucket, you've got a 7-year bucket, 15-year bucket, and then your long bucket. So if it's commercial, it's 39. If it's multifamily, it's 27 and a half. Okay, and we've got these buckets for specific reasons, but just to go over what typically falls in those buckets. Your 5-year bucket's typically going to be things that don't last very long, they wear out fast. Your carpets, your appliances, some of the fixtures, those will be in your short-term 5-year bucket. Your 7-year bucket is going to be more like office furniture, some sort of equipment, that kind of thing. 15-year bucket would be the land improvements generally, not the whole building, but the land improvements. So like your parking lot, sidewalk, landscaping, fences. And yes, to some degree, landscaping can be considered an improvement. Again, I'm not a CPA. That's up to your CPA. Because when you're doing all of this, your CPA, your tax advisor, and your financial advisor are going to be putting together the claim, basically, that you lost or you depreciated a certain part of your property. And then they're going to have to defend that. If the IRS comes and wants to learn more about that, they're going to have to defend that. So they're the ones who are going to decide for you, because they work for you, what does or doesn't fit in different buckets. But generally speaking, that's what it looks like. And then our long-term bucket would be the main structure itself, like the walls, the roof, the foundation. Now, what you'll notice is most things fall in the first 3 buckets, don't they? Most things are going to be there. The big ticket items, some of the big ticket items, yeah, they'll fall under these bigger buckets, the 39-year, the 27.5-year, but most of them are going to be in the first buckets. And what that does is when we separate everything out on paper, we front-loaded to the first 5 and 15 years, most of, or as much as we can, of the depreciable part of your property. So you bought a property, And that $1 million of improvements isn't going to be stretched out over 39 years. You might own it for 39 years, but typically we want to get our return as soon as possible. And when we do that, we typically want to move that forward. So if you've owned property for a long time and you don't have a depreciation schedule, I'm going to show you how important it is that you do have a depreciation going on with your property. If you don't, you should be trading up. You should be continuing to move that equity along to get your best return. But this is why a lot of the larger owners, like I was talking about, the people who have 5, 10, 15,000 doors, they're going to buy something. They're not going to specifically look at the cash flow. They're going to look at their tax flow. What are the taxable write-offs? And I'll show you what this means on paper. But what we're doing is we're having as many taxable quote unquote losses, these aren't actual losses, these are on paper losses, as we can as soon as possible. And then when we've run out of those, here's what we typically do. An owner will suck as much out of this as they can, as much write-off as they can. Once a lot of those are depleted, say the 5 and 7 year bucket is depleted, they've owned it for 7 years. Maybe half of the 15-year bucket's depleted. You get your other buckets. What they might do is they might go and improve the property, do some capital expenses. They might go and improve that roof. And what ends up happening is we're able to take the roof that was in that 39-year bucket, and there's some leftover depreciation in that bucket for that roof. They can then claim, again, ask your CPA, they can then usually claim whatever's left over in that bucket for the roof when they replace it and start a brand new bucket for the new roof, right? So when you were doing this, we'll buy it, we'll hold it, we'll suck as much cash flow out of it, we'll work on this depreciation and those tax write-offs, and then when we go to sell it, part of positioning it for sales, looking at the low-hanging fruit of improvements and CapEx we can do to claim as much more taxable depreciation as we can before we sell it and we move on and we start that depreciation schedule again. Okay? Again, why does this matter? Yeah, front-loaded depreciation, we allow improvements to be on their own schedule, so we could then, like I said, replace them if we wanted to, and we set the depreciation schedule for these CapEx items when, for example, we have a new roof. So here's an example of one from a few years ago. I think I removed any important details. This was a fast food building that my client was looking at. And you'll notice, or you may notice, that there's also accelerated depreciation or bonus depreciation. We're going to get into that conversation in just a moment. But the way you can look at this, you can see that allocation after CSS, cost segregation study, a engineering firm will go in and on paper pull apart all of the pieces of the property and put them in those buckets for you. And just like an escrow company will make sure they're going to guarantee title and ensure the title, a cost segregation defend any question about what's in what bucket and what expected life span is left over, for instance, on the roof. It's a 10-year roof. We think there's about 4 years left, 5 years left on the roof, whatever. So they'll do all that work for you. You can see here there's a $5,000 charge. There's usually a flat fee for them, but they'll pull all them out and put them in their different buckets. And you'll notice up top there it says additional cash flow year one of 156,672. What that means is, if you look at total accelerated, the owner of this property would be able to write off as a taxable loss in year one of owning this. They would have a taxable loss that they could write off as a loss, which means they don't pay taxes on the income that they're writing off, of almost $400,000. They get to claim as a loss $400,000 that year. So this is where I'm talking about a lot, I just had this question the other day from a multifamily owner of mine. And, they got a couple dozen doors. They were asking how owners end up paying zero income tax when they own so much property. This would be one of those ways. Okay, so let's look in detail really quick about this. If you look here, this is what the depreciation looks like. And in the black there would be what's considered straight line. So that would be dividing it. This was, again, a fast food, so it'd be by 39 years. So 1/39th of the value of the property would be written off over that period of time. Now, that big giant blue bar on the left, that's bonus depreciation. That's what's coming back. That's what they're looking at renewing. This is what happened in 2017. They passed the Tax and Jobs Act of 2017. They're looking to renew it. This is what they would be looking to do because this is starting to sunset. And I'll go into that in a moment, but let's look a little bit closer at straight line depreciation, or 1 divided by 39, or the value divided by 39 would be that middle, bar, that middle column. Says current depreciation. That's if you divided it evenly over 39 years, you could write off as a loss almost $40,000 a year, which means don't pay taxes on $40,000. You don't owe taxes. You get to claim that you lost $40,000. Now on the left, depreciation after CSS. You notice on the bonus line item, there's a big giant $400,000 write-off. That's a loss. I'll explain. But the balance of what's left over would be those 28,986 all the way down. So they get to claim a big portion up front, and then the rest gets split up over the next 39 years. So that's a difference of, about a little over $10,000 per year in write-off, but he gets to claim a whole bunch up front. Here's how that works. Okay, hopefully you're following. We got our buckets. We got our 5-year bucket, our 7-year bucket, our 15-year bucket. These are places that the improvements can go. They're going to last 7 years. They're going to last 5 years. They're going to last 15 years, right? Those buckets, every now and then, when Congress or the Senate or whomever needs a political win, they'll introduce legislation that does what we call accelerated or bonus depreciation. So we have these buckets all the time, but they did, and they're planning to renew what's called bonus depreciation through the Tax and Jobs Act. And what that means is any bucket, this is what it says, any bucket that is 20 years or less, if you have a 20 years or less bucket, which there's 3 major ones, you get to claim all of those in year 1. So when we look at that top there, which says bonus of almost $400,000 for my client, that's what that means. There's $400,000 of his new investment that he then gets to say is a write-off. It's basically on paper, it's a loss. So he gets to wash his hands of $400,000 of income and not pay taxes on it, not have to, in this case. Now that's since started to sunset. They're going to renew that. That's the plan. But what you can see is the rest of that, those 28,986, that's what would be left over every single year for this client. So to reiterate, bonus depreciation is saying, look, we have all these buckets. I'm going to claim a bunch of them now. I'm going to empty all these buckets now, all these write-off buckets now, and then leave the rest for later. And that's what bonus depreciation is. Likely that's going to come back with the renewal of the Tax and Jobs Act. And I'll show you exactly how this works in real life. So we're going to use this same example. This, again, was a fast food. These are the actual numbers, right? I think the purchase price was like, you can see here, the basis was $1,704,000. You can see that bottom number. See that circled in red? His total accelerated depreciation, which means his write-off was $400,000. And what that means is he would not have to pay in taxes. Again, consult your CPA. He would not have to pay essentially $156,000. That means he makes $156,000 extra dollars because he didn't have to pay taxes on that in taxes. He just gets to keep that. So instead of paying taxes, it goes in his pocket. Okay, so let's run the numbers. Let's run the numbers back again. So you can see exactly how this looks and exactly how he can make so much money. And actually, you know what? I'm going to present my screen so you guys can follow my cursor, because I know you guys can't see my cursor, but I think we can do this too. Banner. If you want to know if this would work for you, you can jump on there and answer some questions, and we'll go ahead and do a full property optimization plan for you. Okay. So yeah, let's jump over here so you can see my cursor. Let's catch up. Okay, we got our buckets. Cost segregation study. That's a straight line. This is not a straight line that we want to go. Here we are. Okay. So this is what he gets to keep instead of pay taxes. This isn't what he would be taxed on. This is the money he gets to keep in his pocket that would have otherwise been taxed. Okay. With those numbers, assuming he makes $400,000, right? So if we run the numbers, the purchase price was 1.7. Using round numbers, I think it was a little bit better cap rate than this, but using round numbers, roughly $100,000, right? $100,000 in net income. It's a 6% return. So this is what your typical owner is going to say. You're typically going to say, hey, well, net income, so my return's 6%. No, your return's a lot different. Depends on your situation. So I just pulled this tax table up, but just roughly saying he, on that 100,000, I get to keep all of it. He would pay, I don't know, about 20,000 in taxes to Uncle Sam. So you get to keep about 80 in any normal situation, right? However, because we did a cost segregation study, and because I don't see any comments. Because we get a cost segregation study, and because he gets to keep and not pay $156,000, this is an additional cash flow that he gets. He gets that much extra tax. He gets to keep it in year one. What kind of return would that look like? Okay, so he makes $100,000 in net income. He gets to keep an extra $156,000. This is assuming he's making $400,000, right? So total, if he were to use all that depreciation up that he got in year one, his total return, because he gets to keep money he otherwise would have paid tax, he gets to keep about $250,000. So that's a 15% return. So his return's not 6%, closer to 15%. But it gets better. This is where I'm talking about making 50% or better. What if he leveraged? What if he got a loan? So a lot of owners they'll own something, free and clear. They'll own it for years. They'll have no more depreciation left, and insist that they're making a good return. Well, I mean, it might be headache free, but it's not necessarily a good return. The problem is you're not getting this depreciation. This is just so not as good of a return as you typically would think. So what you should do, though, to reset your depreciation schedule is you should leverage up. And let's assume this client of mine, instead of paying cash, he did a 20% down. So he spread this, he had, I think 3 or 4 million, spreads it out over a bunch of different properties and leverages as much as he can on. What would that look like? What if they came in with 340,000? How does that change everything? Well, let's just assume, because he's leveraged so high, that he has no cash flow. The debt service wipes out everything. There's no debt coverage ratio. They say whatever, it can be a one-to-one debt coverage ratio. No cash flow. And I did run, I misspelled assume. Ask me, right? Assume in year one with current, I just did 25-year amortization. He's got about 31,000 in principal pay down coming his way. If he got a loan, so zero cash flow, but he is getting his loan down by 31,000. All things being considered, let's assume the property remains. It doesn't appreciate, but it doesn't depreciate. So what exactly does that look like? as far as a return. Okay. Again, I'm not a CPA or tax or financial advisor. These are just for commentary. This is so you can go back to yours, or you can go to apartmentequityreport.com and get an analysis on your property if you're curious. Let's say we add those up. So the income that he gets to keep instead of paying the taxes is 156. The principal paydown of his property, which is equity buildup, doesn't go into his pocket, but it is return. It's buildup of his equity. It is a return he gets when he sells. That's $31,000 in year one. So total, that's $187,000 on year one. This is what we're getting. And what's great is, yeah, now's a good time to remember. I'm not a CPA, not a tax advisor. These are hypothetical. Please consult a professional when you're doing this. The matter is, whether you leverage or you don't leverage, you still get to claim. Let's go back in time. Let's go back here. Oh my, so I took a screenshot of this piece. Whether you leverage or not, you still get to do the depreciation. On paper, you still get to write, whether you're leveraged or not, your taxable loss. So you did the study, you had everything pulled out, you did the bonus depreciation, you get to claim that you lost, on paper, $400,000 in that year, which means you don't have to pay taxes on a certain amount of that, which would amount to about $156,000. So instead of giving Uncle Sam $156,000, you get to claim the loss, and you get to keep that in your pocket. Hypothetically, right? Let me make sure we go back to this slide. So, look on the left there, additional cash flow plus the principal pay down equals 187. 187 divided my money into the deal, getting no cash flow from the deal. But this client is making, on paper, over a 50% return in year one. It's not going to be every year, but they still get to claim another $29,000 every single other year. This is just one piece of the stacking returns that I'm talking about, right? So it's not cash flow. In this case, he has no cash flow, right? So he's got debt service. He leveraged to the hilt, no cash flow from this property. Say he's got too much spending off of other investments, no cash flow here because he needs more tax write-offs. Needs more tax shelter to happen. So he's done this. Isn't that cool? If you want to learn, if you qualify, or if your property qualifies, or any low-hanging fruit that your property has for making more money, decreasing expenses, streamlining things, tax incentives you might not be aware that you qualify for. I'm talking energy efficiency tax credits, things you're already doing to your property that might qualify for different write-offs or grants or tax breaks. Go to the apartmentequityreport.com. It's a 3 to 5 minute quiz is all you need. Okay, we ask a couple questions about your property, when you bought it, what your debt situation is, what its situation is, right? Because we sometimes can't see all the unit mix from our CoStar or our Quixie. So just tell us the basics of your property. You don't have to get in detail. It takes about 3 to 5 minutes. We'll put together a full, we call it a POP, property optimization plan. It's a full plan on A to Z, what you can do right now, starting with the low-hanging easy fruit to make more money for your property, optimize your investment, and it's all the usual stuff too. It's your market rent survey, it's a property valuation, it's all the usual stuff, but it's also all of this extra stuff too. It's all the stuff that you could do right now to improve your property, improve your investment. That doesn't necessarily mean sell. That oftentimes means adjusting different leasing practices, adjusting or applying for different tax incentives There's a lot more to investing than just buy, sell. Okay, you know that. And so it's our job to know as much as possible about what is out there and available. All you have to do is complete a quick quiz, and then we go in and we get you a full report on that. Now, we'll get you the report. We'll tell you what we think could be done to the property to improve things or optimize things, as it were. And then you can go and do it yourself, or you can have us do it for you. If you want to, you can hire us to come in and help you implement the plan, or we could tweak it and do that as well. It's up to you. But if you're curious about that, go to apartmentequityreport.com. There's other options there too. If you wanted to look at offers for your property, same thing, quick 3 to 5 minute quiz. We'll get you some initial offers that you could look at. No commitment, just initial what people would pay for that, just in case you wanted actual offers on the table, or if you're looking at someone buying your property and you want something to compete with, for them to compete with, hold their feet to the fire, as it were, you can do that. If you want to get on our buyers list, there is a vetting process. This isn't just get on the list and you get an email blast. These are highly vetted buyers and owners who are really looking for property. So if you want to, you can go there, get on our buyers list. You will be vetted, and once you're vetted, you'll be on the inside track to receive an alert and be one of those possible buyers for anyone who wanted to consider some non-binding offers to purchase. So hopefully this helps. This is just, again, one piece of the entire investment stack, stacking returns. Next, we will talk about return on equity, not return on investment, because those are two different things. A lot of owners might think they are getting a 10% return when they're actually getting a closer to 2% return on their equity. And then we throw things like this into the mix, where we show them not only are you getting a 2% return on your equity alone, you could be getting an additional, like I just showed you, like 50% return on your investment if you were to make a move here or a move here, or reposition your debt stack, stuff like that. So hopefully this helps. If you have any questions, go to apartmentequityreport.com. We will help you out, and we will see you at the next presentation of the stacking returns.